Why do some people become wealthy, while others, who seem just as smart and hardworking, struggle their entire lives? Here's the thing. It's rarely about what you know. It's about how you behave. And that's exactly what Morgan Housel explores in The Psychology of Money, a book that challenges everything we think we know about wealth, success, and financial decision-making. Let's start with a story that sets the tone for this entire book. Ronald James Reed was a janitor and gas station attendant in Vermont. He never earned more than minimum wage. When he died in 2014 at age 92, his estate was worth $8 million. $8 million from sweeping floors and pumping gas. Around the same time, Richard Foscone, a Harvard-educated executive at Merrill Lynch who earned millions annually, declared bankruptcy. So what's going on here? How does a janitor end up wealthier than a high-powered executive? The answer is simple but profound. Financial success isn't about how smart you are or how much money you make. It's about how you behave with money. Ronald Reed was patient. He lived below his means. He invested quietly and consistently for decades. Richard Foscone, despite his intelligence and education, took too much risk and spent beyond his means. Housel's central message is this: doing well with money has little to do with intelligence and a lot to do with behavior. And behavior is hard to teach, even to really smart people. Think about it. We spend years learning math, science, and history in school. But how many classes did you take on patience, on emotional control, on resisting the temptation to keep up with your neighbors? These soft skills matter more than any financial formula. Here's something that might blow your mind. When you see someone driving a Ferrari, you might think, wow, that person must be really successful. But here's what Morgan wants you to understand. You have no idea what game they're playing. Maybe they're a day trader who needs to show off to attract clients. Maybe they inherited money and this is their way of enjoying it. Maybe they're broke and leased it to impress people. Or maybe they worked hard, saved diligently, and this is their reward. The point is, everyone has different goals, different time horizons, and different definitions of success. And this creates a huge problem. We often take financial advice or cues from people who are playing a completely different game than we are. Imagine you're playing checkers, and someone playing chess give you advice. It might be excellent chess advice, but it'll destroy your checkers game. If you're a long-term investor saving for retirement in 30 years, you shouldn't be taking cues from someone day trading stocks. If you want to build generational wealth, you shouldn't model your lifestyle after someone who's optimizing for looking wealthy today. The lesson is, define your own game. Know what you're playing for. And don't let someone else's scoreboard distract you from your own goals. Let's talk about the most powerful force in finance, and it's not what most people think. Warren Buffett is worth over $100 billion. But here's the crazy part. $97 billion of that came after his 65th birthday. In other words, if Warren Buffett had retired at 65, still incredibly wealthy at $3 billion, nobody would talk about him as one of the greatest investors of all time. His secret isn't just that he's good at investing. It's that he's been good at investing for an incredibly long time. He started when he was 10 years old. He's been compounding his wealth for over 80 years. This is the power of time in finance. Compounding doesn't rely on earning big returns. It relies on earning good returns for a long time. Here's a thought experiment. Would you rather have $3 million right now or a penny that doubles every day for 31 days? Most people would take the $3 million. But that doubling penny, on day 31, you'd have over $10 million. That's compounding. It seems slow and boring at first. On day 5, you only have 16 cents.
On day 10, just $5. But by the end, it's extraordinary. The challenge is that our brains aren't wired to understand exponential growth. We think linearly. We see slow progress and think nothing is happening. But if you can just stay in the game long enough, compounding works magic. Now, getting rich and staying rich are two totally different skills, and they require opposite behaviors. Getting rich requires taking risks, being optimistic and putting yourself out there. It's about offense, about going for it. Staying rich requires humility, frugality, and a healthy paranoia about what the future might bring. It's about defense, about not losing what you've gained. Housel tells the story of Jesse Livermore, one of the greatest stock traders in history. He made and lost 4 fortunes in his lifetime. He was brilliant at getting rich. His market instincts were legendary. But he couldn't stay rich because he kept taking the same massive risks that made him wealthy in the first place. There's an important truth here. Survival is the most important thing in finance. You can't succeed without surviving. All the brilliant investment ideas in the world are useless if one bad year wipes you out completely. This is why having a safety margin is so critical. Don't use all your borrowing capacity. Don't invest money you need next month. Always assume that the future will be more uncertain than you expect. The key to staying wealthy is understanding that enough is enough. You don't need to keep taking risks once you've won the game. But this is emotionally difficult because the goalposts always move. There's always someone richer, always a bigger yacht, always one more million that would make you feel secure. Learning to say, "I have enough," might be the most important financial skill of all. Here's something that might surprise you. Most things in finance don't work most of the time. Let's look at venture capital. A good VC firm might invest in 40 companies. 30 of them might fail completely. 5 might break even. 4 might do okay. And one, just one, might become Google or Facebook and return 1,000 times the investment. That one winner makes up for all the losses and generates the profit. The same is true for your career, for innovation, for investing. Most of your outcomes come from a small number of events. Housel points out that if you look at Warren Buffett's investing track record, most of his returns came from just 10 investments out of hundreds he's made over his lifetime. The vast majority of his decisions were just okay or even money losers. But a few massive winners carried everything else. What does this mean for you? First, it means you can be wrong a lot and still do great. You don't need to be right all the time. You just need to be really right a few times and make sure those few times count. Second, it means you need to stay in the game long enough for the tail events to work in your favor. If you give up after a few losses, you'll never be around when the big wins happen. Third, it means we should be more forgiving of failures, both our own and others. Failure isn't the opposite of success. It's part of the process. The key is making sure no single failure can knock you out permanently. So what's the point of money? What are we really after? Housel argues that the highest dividend money pays is the ability to control your time. Money's greatest intrinsic value is its ability to give you options, flexibility, and control over your schedule. Think about it. What makes people happiest isn't big houses or fancy cars. Study after study shows the #1 predictor of happiness is having control over your day. Being able to wake up and say, "I can do whatever I want today," is the ultimate wealth. This is why the highest form of wealth is the ability to wake up every morning and say, "I can do whatever I want today." Not having to commute to a job you hate, not having to ask permission to take a day off, not being trapped by financial obligations that force you to work when you'd rather be with your family or pursuing your passions. The paradox is, we often sacrifice this freedom in pursuit of money. We take jobs we hate because they pay well. We work 80-hour weeks to afford things we think will make us happy. We give up our present life to build a future one. But the happiest people, Housel suggests, are those who figured out how to use money to maximize their control over their time as early as possible. This might mean earning less but having more flexibility. It might mean living in a smaller house so you're not trapped by a massive mortgage. The goal isn't to be rich. The goal is to be free. Here's an uncomfortable truth. Nobody is impressed with your possessions as much as you think they are. Housel shares this insight. When you see someone driving a nice car, you don't think about the drive.
Imagine you're driving on a winding mountain road. There's a cliff on one side. Would you drive right at the edge to maximize your efficiency and cut the corner? Of course not. You'd leave a margin for error because a small mistake would be catastrophic. The same principle applies to money, but we often forget it. Housel emphasizes that the most important part of every plan is planning on your plan not going according to plan. You need room for error. You need buffer. You need margin. This means several things practically. Don't invest money you'll need in the short term. If the market drops 30% right when you need to pull your money out, you're in trouble. Leave yourself options. Don't borrow to the maximum you can afford. If interest rates rise or your income drops, you need breathing room. The person who could technically afford their mortgage payment is just one unexpected expense away from disaster. Don't assume the future will look like the past. Returns might be lower than historical averages. Jobs might be less secure. Plan for a range of outcomes, not just the most likely one. Room for error lets you stick around long enough for good things to happen. It's what keeps you from getting knocked out of the game by a bad break. It's the difference between taking a calculated risk and gambling. The irony is that room for error often looks like a waste when things are going well. That extra cash sitting in savings could be earning higher returns if invested. That conservative spending could buy more stuff. But when things go wrong, and they always do eventually, that room for error becomes the most valuable thing you have. Here's an uncomfortable truth. You're going to change, probably in ways you can't predict. When you're 22, you think you know what you'll want at 35. When you're 35, you think you know what you'll want at 50, but you're probably wrong. Housel calls this the end of history illusion. We recognize that we've changed a lot in the past, but we expect to stay the same in the future. This creates problems when we make irreversible long-term decisions based on who we are today. That's why it's dangerous to lock yourself into extreme financial plans. Maybe you think you want to retire early and travel the world, so you save aggressively, live extremely frugally, and make everything about that goal. But what if in 10 years you discover you actually love your work, or you have kids and want to provide stability instead of adventure? Or maybe you take on enormous debt for law school because you're passionate about law, but 3 years into practice, you realize you hate it. Now you're trapped by student loans doing work you despise. The solution? Avoid the extreme ends of financial planning. Don't plan as if you'll never change. Balance your plan for today with flexibility for tomorrow. Make decisions that are reversible when possible. Accept that regret is unavoidable. You're going to regret some decisions no matter what, but try to minimize catastrophic, irreversible regret. This is another reason why financial independence is so valuable. When you're not trapped by financial obligations, you're free to adapt as you change. You can pivot. You can try something new. You can become a different person without destroying your financial life. Let's talk about the price of investing success, because there is one, even though it's not obvious. Housel uses this metaphor. Imagine you want a nice car. You go to the dealership and they tell you the price is $30,000. That's clear. You understand the transaction. You decide if it's worth it. But investing doesn't work like this. The price of investment success isn't listed anywhere. It's paid in different currency: volatility, fear, doubt, uncertainty, and regret. The market's long-term returns are excellent,
But the price you pay for those returns is dealing with the inevitable downturns, the sickening feeling when your portfolio drops 20%, the voice in your head screaming, "Sell everything." Most people try to get around paying this price. They try to time the market, jumping in and out to avoid the downturns. But this doesn't work. You can't get the returns without paying the price. The key insight is recognizing this price and deciding whether you're willing to pay it. It's not a fine for getting something wrong, it's an admission fee. It's the cost of doing business. If you understand that volatility and temporary losses are the price of admission for long-term growth, you'll be less likely to panic and sell at the worst time. You'll recognize that you're not being punished, you're just paying the price that everyone has to pay. Some people decide they're not willing to pay this price, and that's fine. They can choose more conservative investments with lower returns and less volatility. The mistake is trying to get the returns without accepting the price. Remember at the beginning when we talked about how everyone plays a different game? Let's come back to that with a specific warning. Be careful who you take financial advice from. This seems obvious, but it's surprisingly easy to mess up. Here's why. When you see someone taking action in the market, buying or selling a stock, making a bold move, you might be tempted to follow along, but they might be playing a completely different game than you. A day trader needs entirely different strategies than a retirement investor. Someone saving for a house down payment next year has different needs than someone building generational wealth. Someone with a trust fund can take risks that someone living paycheck to paycheck cannot. But we all see the same market prices, read the same headlines, and watch the same CNBC. This creates confusion. We see someone else winning their game and think we should copy their strategy, not realizing it might be terrible for our game. Housel gives this example. Imagine a stock goes up a lot. An investor who bought yesterday might sell to lock in quick profits. That's their game, short-term trading. But you, planning for retirement in 30 years, might see that sale and panic, thinking they know something you don't. So you sell too. But you just sold a long-term investment based on someone else's short-term game. The solution is to define your game clearly and ignore anyone who's playing differently. This is harder than it sounds because we're social creatures. We want to fit in, to do what others are doing. But your financial success depends on playing your own game, on your own timeline, by your own rules. Human beings are storytelling creatures. We don't just want information, we want narratives that make sense of the world. And this creates both opportunities and dangers in finance. Housel explains that we're more likely to believe information that fits a good story, even if the data is weak. And we're likely to dismiss information that's boring or complicated, even if it's true. This is why market bubbles happen. It's not that everyone suddenly becomes stupid. It's that a compelling story takes hold, like, "This time is different," or "Housing prices never go down," or "This company will change everything." And the story becomes more powerful than the facts. During the dot-com bubble, the story was that the internet would revolutionize everything, and therefore any company with .com in its name deserved a massive valuation. The story was partially true. The internet did revolutionize everything, but the valuations were insane. The story was so compelling that people ignored basic financial fundamentals. The same thing happens in our personal financial lives. We tell ourselves stories to justify our decisions. I deserve this luxury because I work hard. I'll save more next year when I make more. I'm smart enough to beat the market. These stories feel true because we want them to be true, but they're often just narratives we've constructed to justify what we want to do anyway. The antidote is to be aware of the stories you're telling yourself. Question them. Look for disconfirming evidence. Ask yourself if you'd believe this story if it was about someone else. And remember, the most important financial story isn't about making a fortune. It's about sleeping well at night. If your financial strategy requires believing a story that keeps you anxious and checking your portfolio every hour, it's probably not the right strategy for you, regardless of what the numbers say. Here's a question. Would you rather be perfectly rational or reasonably happy? In finance, we often worship rationality. We talk about optimal strategies, efficient portfolios, and maximizing expected returns. But Housel argues that being reasonable is more realistic and sustainable than being coldly rational. Here's what he means. A purely rational investor would never touch bonds because stocks have higher expected returns over long periods. They'd be 100% stocks, all the time. But is that reasonable? What if the market crashes 40% right before you need to pull your money out? The rational strategy becomes unbearable. A reasonable investor might hold some bonds, even though it lowers expected returns, because the peace of mind is worth it. They can sleep at night. They won't panic and sell at the bottom. And ironically, this suboptimal strategy might lead to better results because they can stick with it. The same principle applies everywhere. It's rational to invest every spare dollar, but it's reasonable to keep some cash on hand even if it earns nothing because flexibility has value. It's rational to choose the career with the highest salary, but it's reasonable to choose one you enjoy more, even if it pays less. You're not a robot. You have emotions, fears, needs for security and control. A financial plan that ignores your psychology, even if it's mathematically optimal, is a plan that will fail because you won't stick to it. The key is knowing the difference. Don't confuse reasonable with lazy or undisciplined. A reasonable strategy is still disciplined and thoughtful. It just acknowledges that you're a human being with human needs, and it optimizes for long-term sustainability rather than short-term perfection. Let's talk about two sides of the same coin, luck and risk. Luck is when randomness works in your favor. Risk is when it works against you. And both play a much bigger role in financial outcomes than we like to admit. Housel tells the story of Bill Gates. Yes, Bill Gates was brilliant. Yes, he worked incredibly hard. But he also went to one of the only high schools in the world that had a computer class.
We've covered a lot of ground. Let's pull it together. The psychology of money isn't really about money at all. It's about behavior, emotion, and psychology. It's about understanding that financial success has less to do with intelligence or even income, and more to do with how you behave over long periods of time. The core principles are simple, but not easy. Understand that everyone plays a different game. Define your own goals and ignore comparisons. Recognize that time is your most powerful tool. Let compounding do the heavy lifting. Build room for error into everything. The future is uncertain. Give yourself options. Focus on freedom and flexibility, not stuff. The best dividend money pays is control over your time. Accept that nothing is free. Every investment strategy has a price. Decide if you're willing to pay it. Be reasonable rather than purely rational. A plan you can stick with beats an optimal plan you'll abandon. Stay humble about luck and risk. Things are never as good or bad as they seem. Live below your means without a specific goal. Flexibility has immense value. These aren't revolutionary ideas, but that's kind of the point. Building wealth doesn't require genius or sophisticated strategies. It requires patience, discipline, and the ability to control your behavior, even when it's emotionally difficult. The people who succeed financially aren't the ones with the highest IQs or the best stock tips. They're the ones who can save consistently, invest patiently, avoid catastrophic mistakes, and stay in the game long enough for compounding to work. So here we are, at the end of our journey through the psychology of money. If you take away just one thing, let it be this. Your relationship with money is uniquely yours. It's shaped by your experiences, your goals, and your psychology. There is no universal right answer, no perfect strategy that works for everyone. What matters is understanding yourself. What makes you sleep well at night? What level of risk can you handle? What does wealth mean to you? Is it a big number in a bank account, or is it the freedom to spend Tuesday afternoon with your kids?
The good news is that once you understand yourself and embrace these principles, building wealth becomes straightforward. Not easy, but straightforward. Save more than you spend. Invest for the long term. Avoid catastrophic mistakes. Be patient. Boring? Maybe, but boring wins. Ronald Reed, that janitor we met at the beginning, understood this. He didn't need sophisticated strategies or insider knowledge. He just needed patience, discipline, and time. That's available to all of us. Thank you for listening. Now go make smart, boring, patient choices with your money. Your future self will thank you.